AMD has fallen in more than half year to date. This thing went from a high of around 164, and today we are currently sitting at $76. That is more than a 50% drop on an amazing company, a leader in the industry. This doesn't change that, but what price are we comfortable paying for this company? That becomes the question. So let's pull up 8 pillars before we go and look at their last quarterly report. 5-year PE sitting at 81. That's a little rich. 5-year price to free cash flow, 98. That's a little rich. Big share dilution. I'm not sure if this is actually share dilution or some type of acquisition. We'll check it out. The debt situation, I do not love. ROIC is very low, which is worrisome because to me, when I look at a company that's $123.5 billion, I say to myself, how are we going to know how this company is investing their money? Well, to me, I can't go and talk to the CEO. I can't go and talk to the CFO. I could talk to people maybe in investor relations, but I can't go and just talk to them directly. So this ROIC number, the return on invested capital, tells me how good they are at reinvesting in themselves. So that's a number that is worrisome right off the rip for me. Let's go over here to their quarterly report. Now, why did I highlight their gross margin of being up 46%? Because Intel's was so dismally low. That is why I wanted to make that comparison. So I'm seeing this is definitely lower, but with inflation, chip shortages, and everything that's going on, they've done a good job of kind of sustaining themselves and they're not getting absolutely hammered in that department. Revenue. Intel's revenue was way down. NVIDIA's revenue, I'm not exactly sure of off the top of my head, but AMD's revenue up 70% year over year. Absolutely crushing it. Intel's was just decimated. Gross margin down 140 basis points year over year. Not the worst for the inflationary environment that we're in. And net income down 37% again with inflation. Not only that, not only with inflation, but with inflation and all the supply chain issues. It's not terribly surprising that they have a little bit of a drop. Well, more than a little bit. But to me, I think it's going to be okay. I think it's more temporary. We delivered our 8th straight quarter of record revenue based on our strong execution and expanded product portfolio. This is an absolutely amazing thing to see in this type of environment. I'm pretty impressed with what I'm seeing so far with AMD. The only problem that I have is, what do I want to pay for this company? The data segment center. They have touted this data center segment for a very long time, and it's doing an excellent job. Revenue was $1.5 billion, up 83% year over year, driven by sales on this EPYC server processor. So everything that they're doing is they're kind of hitting on all the right cylinders in there. Did I highlight anything else? I do not believe I did. Okay. Oh, maybe I did. Increase of approximately 55% year over year. Growth led by their data center, increasing 60. So let me slow this down. Future guidance. Where are they guiding to? A lot of these tech companies are, you've seen it. They are really trimming out their future guidance. They're saying, hey, it's going to be worse than it's a global economy and we can't do anything about it. AMD is out here saying we expect to see an increase of approximately 55% year over year. You're not seeing that across this sector. An increase of about 60% year over year in total for their revenue. So this company is not slowing down. That is a really great thing to see, especially what we've seen with the NVIDIAs of the world, the Intels of the world, the Googles of the world, the Facebooks of the world. These guys are still saying that, hey, we can do this. I'm hoping that they're not overpromising, underdelivering, and setting themselves up for some type of really big failure situation. Now, I did talk about acquisitions. Let's just go and check, were there any acquisitions made? No, there's actually a disposition made of about just under $1 billion. Let's see, net income. So here's what I don't love. Their net income, now they're still in a big growth phase. Their net income was, let's go 5 years, negative $500 million, positive $239 million, positive $191 million, positive $609 million, positive $3.5 billion, positive $3 billion. Those are not sustainable numbers, I don't think. Now, I could be wrong, but the whole industry, we've heard people say that the computer industry is absolutely slowing down now because people are not sitting at home as much. They're maybe not going to be buying another computer for 5 years because they already got one. They're not going to have to go and do it again. And these types of companies have benefited from that. Now, the shares outstanding number. This shares number is pretty worrisome, especially with where the price was. I said just a year ago, beginning of the year, it was $164 a share. So look at the share increase that's been going on. This thing has been increasing. They have gone from about 800 million shares to 1.62 billion shares in a matter of 5-6 years. That's not a good thing if you're an investor. That is not a good thing if you're an investor in a company because you're getting less of the pie. And they were doing it at very, very frothy valuations. Now, it's not bad every time, but I think it's bad in this instance. Let's look at analyst expectations here. Year over year earnings per share growth. Hey, it's there. I mean, for them to be doing basically 17% year over year growth on earnings per share in December of 26, I think that's very solid. Year over year revenue growth in 2026, about 12.5%. So the way that I saw that this company had priced in, it looked like they were pricing in maybe 40% revenue growth 4 or 5 years from now. I think this is a lot more reasonable. And when I do stock analyzer tool, I'm going to put this in here at the high side, this 12.5%, and I'll base my judgment off of that, and I'll go from there. Guys, my name is Mo. I'm a value investor. I look at companies from a quantitative and qualitative basis, but the numbers need to make sense to me first. And that's why I'm going through and looking at all of these numbers and all of these forward guidances, just to make sure that when I pay for a company like AMD, I'm not paying, current market cap was what? Current market cap was $123.5 billion. Well, I think that maybe this market cap isn't deserved. Let's just make up a number here. Let's say that this company is worth $90 billion to me. Well, I don't want to go out and say, just because their stock was at 164, say it was a $200 billion company, just because the stock price is high doesn't mean I'm going to go pay $250 billion for the company. I don't want to do that. Maybe $90 billion is what I need to pay. Maybe I just need to be selective and I need to be patient and wait for that number to come. So right now, let's go to Stock Analyzer tool and figure out what exactly we want to pay for this. Now remember, whatever spits out on Stock Analyzer tool, if everything is green, I'm going to press analyze after I input some data, and I'm going to get 6 numbers right here. Just if they're all green, that doesn't mean go buy the company. It means, okay, now this is what I need to pay for the company. Now let's go see if these numbers actually make sense. See if these numbers that I put in for revenue growth, profit, etc., actually are going to happen or have a good chance of happening in the future. So revenue growth, you can see basically 62% in the last year. That's not reasonable. We said that high number is going to be 12.5 because that's what the analyst said. Mid number, I'll put in 8.5. And for the low number, I'm going to put in 5.5% revenue growth over the next decade. Profit margin. Let's go. You see, the profit margin has been sporadic, especially with what's gone on since COVID. So let's put in some numbers here of, let's put in 3.5, 5, and 6.5. Free cash flow margin. I'm going to do the same numbers just because they are in that range. But remember, after I put in these numbers, these aren't the end all be all. These numbers can be changed, and this is just a starting point for me. So for my PE, I'm going to put in 14, 16, and 18. I'm going to do the exact same thing for price to free cash flow. And my return, I am going to put in 12.5%, 13.5%, and 14.5%. And the reason I put those numbers in is because I don't necessarily think that this is the most risky investment in the world. This is a good company. So if this company does, or they even miss by a little bit on that high side of that revenue and that profit margin, or if they hit, I don't need to get a screaming return. Average return of a low-cost ETF is about 10%. So I don't need to get much more than that. I don't think this company has any risk of going to zero. Let's hit analyze and see what comes out. So right now, the company is expensive. And a lot of people are going to probably argue with me on these numbers. I can go and change these and make them a little bit more rich, and maybe they do hit on all cylinders. But remember, analysts are going for this number. This is analysts going out to 2026. So it's not just me saying this. This is a conglomerate of analysts also saying this. So right now we're sitting in the range of about $7 to $20. And I'm probably starting to look at AMD somewhere around the $35 range, not to buy it, but to maybe sell some puts on it somewhere in this $20, maybe $25 range and go on from there. So actually I just noticed right here, look at this. It's on my watch list already for $15.69. So that's exactly what I'd be looking for. Now, let's look at this. I'm doing 10-year. Those analysts are going out 5 years. Let's change it to 5 years and see what we have. Remember, they're looking at 5-year growth. We're still in that same range. My number is $15.69, $6.61 to a high of $18.24. So based on me, based on the market environment, based on analysts, which I don't love, but they do a job, I think that we're kind of somewhere in this. Start looking at it around, I would really start paying attention. I'm going to move this up. I think I should start paying attention around $35. And the reason is why? I want to be looking if I can be selling puts on it. So if I can get to $35 on this thing and the price actually hits there, basically cut in half from here, then I can say, okay, at 35, now I'm going to start looking at them around $20 a share, and I'll sell puts to own them at $20 a share for some future date, and that's going to be a way for me to generate income. And I am right now, I'm going to change this thing and put it in at 35 bucks. $35 on the nose. If you want to learn how to sell options, you need to go and watch this video right here where I perfectly explain what selling puts are, and it's going to tell you exactly what you need to do to own this company at a cheaper price. Catch you on the flippity flop.